Welcome back. Joining us for a look at the day's markets action is Nicholas Pittaway from Sasfin Wealth. Nicholas, thanks so much for joining us this evening. Now, I want to get started with some general markets action. Just before we went into a break, I did a quick wrap-up of what was happening in markets. And I mentioned, we are seeing positive sentiment playing out in the US. But when you look at European markets, when you look at our local markets, even in Asia, it's a mixed picture, it's a sour picture. Talk to us about what's driving sentiment on that front.
Thanks, Tarling. Yeah, thank you for having me. At the moment, I hate to say it, but Donald Trump coming in, he's really been set to be the next president. And it has affected things quite radically. I know in South Africa, you can imagine all the optimism around, having our new government, and you saw our markets move up nicely. With Trump coming in, there's a lot that comes with it. And with him, he's even nominated the guy who's going with him is Vance, JD Vance. They're anti-China. They're they really are trying to build America, make it great again, as they would say. And for that, the likes of emerging markets and China, it's taken a bit of a back seat. So that's really what we're seeing play out a bit here at the moment.
Now, I can see how, the sentiment around Trump coming into power, possibly come November, would trickle down into, China, because, that Trump-China tension playing out and that kind of filtering through to our markets. I want to now take a look at what's been playing out in earnings season. We had the last few bank earnings come through. It was Morgan Stanley and Bank of America. Bank of America posting declines in profits, while Morgan Stanley topped estimates. Let's just talk about those numbers in greater detail.
Yeah, sure. These banks really form part of the Trump trade, as you would say as well. It really speaks to US good sentiment. So look at Morgan Stanley. Revenue grew 12% to 15 billion, with strong growth coming from the investing banking side. Morgan Stanley actually has the least exposure to interest rates. So they're actually more on the acquisitive, the investment side of the banking or finance. So well-managed costs and good growth on the top line, which led to growing over 40% to roughly $3 billion. So really a good result. The company's done it's up 140% over the last 5 years. So really a stellar business. Bank of America. Yeah, revenue was up modestly 1%, with the increase coming from increases coming from investment banking as well, their side, and then the trading and higher asset management fees, which offset the decline in the income coming from lending activities, which was a little bit it's been under, if you can imagine, with high interest rates, it has been under pressure. So Bank of America, but you can see it's even opened up 4.5% as of now. So really, it's with the Trump story and the fact that it's coming off a low base, it's actually quite a good story now, because there's a little bit of easing of interest rates, which is also expected to take place. So consumers less under pressure, probably a little bit in a better position to start lending again.
Quite funny how markets move. Just a week or two ago, we saw that AI rally just boosting the NASDAQ and S&P. Now we're seeing these value stocks and, the banks, the Trump trade, and the Dow Jones kind of powering through at the moment. So it's like you're either on this side or the other side. Yeah,
rotation. It's all about the rotation. So now rotating out of those big stocks that have rallied into the stocks that are a little bit... they're a little bit more leveraged, a little bit more lending behind them. Whereas, the likes of Microsoft, all these big companies have such strong balance sheets. And there's been a rotation into the ones that are... So if you actually look at the Russell 2000, that's a great one to look at, because those are companies that you'll see, they were less loved with high interest rates, and now with the expected drop, they've done really, really well.
Nicholas, the news of the day, I guess, was Richemont, which was out with results. Sales up a tepid 1%, and we are seeing growth across the board except for Asia Pacific. Let's talk about those numbers in detail.
It's such a pity because I mean Richemont it's actually my stock pick. I love this company. It's done so well for a lot of our clients, and you know it's really been a stellar stock to have on the JSE. You know, but 40% of revenue does come from the Asia Pacific, and with China being under so much pressure, it's really been a tough spot. You know, sales have been down, but it's I do, you know, looking at their results. I mean, I mean, you mentioned really the highlights of just what the numbers were, but you know, drumming down into it, 88% of Richemont's profit actually comes from jewelry, and the jewelry space is a very exciting place to be in because it's actually the watch manufacturers, Burberry. You see, I mean, you can actually see luxury as a whole has been taken an absolute knock, and that's even when you look at Europe. The likes of the Burberry, I mean, LVMH, which is their star player, down completely. But Richemont's, it's actually holding up, and I think it's in a very interesting space. Which, yeah, I think if we do get to a stock pick, I'll just chat a little bit more about it.
And that brings me to my next question, because I was about to say that luxury market hasn't really been doing well. We got numbers out, or an update rather, from Burberry yesterday, as you mentioned. Doesn't really look great. So you'd say Richemont is then your pick in that market?
Well, so if you look at Burberry, I mean, Burberry, 27% of Burberry's exposure is into the Chinese market. So during the Chinese, I mean, a lot of what took place was during the COVID, when everyone was locked down, as opposed to being able to go do things, go, you know, head out to the parks or movies, etc. I mean, people were spending and people were buying goods. They were spoiling themselves, and so there was a big spend during that COVID period on luxury goods, and especially in China, you know, and now it's come out, and the Chinese economy is in a bit of trouble. But a lot of these companies, Burberry being at 27%, Richemont still, you know, a very big portion of 30%, but other, like Swatch as an example, 33% exposure to China. So all these companies are really getting affected by this low demand from Asia. But yeah, I think the reason I like the Richemont story is because jewelry the branded jewelry makes up 40%, you know, of jewelry sales, only 40%, whereas handbags and watches, you can imagine your branded watches make up 100% of the market. And with jewelry, it's becoming huge now, where you're starting to buy branded jewelry, and it's you know, because Richemont only, you know, they're the biggest players with the likes of Cartier, as you mentioned. I mean, they're huge. The second biggest is Tiffany, and it's half the size of Cartier. So it's exciting to watch this because it's a growing. It only makes branded jewelry only makes up 40% of the market, and it's really growing. It's quite an exciting space because it really is. There's potential. And it really is where people are headed.
So Richemont, one to watch out for in that space. It really is an interesting space at the moment, considering what is happening in China. Nicholas, thanks so much for your time and those insights. That was Nicholas Pittaway from Sasfin Wealth.